Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Monday the 6th of November. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, US non-farm payrolls increased 150,000 last month, less than expected, and barely half of a downward revised 297,000 advance in September. Economists had expected a total of 180,000 new jobs for October. The unemployment rate climbed to a 21-month high of 3.9% in October from 3.8% in September. The report also showed monthly wage growth slowing and the participation rate ticking down. A private gauge of China's services activity grew less than expected in October, adding to signs of fragility within the economic recovery. The Caixin China General Service PMI rose slightly to 50.4 in October from September's 9-month low of 50.2. That was below the consensus estimate among economists of 51. Hong Kong's private sector activity contracted further in October to an 11-month low, as new business, including that from Mainland China, continued to fall. The S&P Global Hong Kong PMI dropped to 48.9 in October from 49.6 a month earlier. That was the fourth straight month of falls in private sector activity and the lowest reading since November 2022 due to a sustained drop in new orders and a decline in output. Danish shipping line Maersk, a bellwether for global trade, said Friday it will cut 10,000 jobs, almost a tenth of its workforce, after it reported sharp falls in revenues and profits in a difficult market environment. Maersk said it would cut its workforce to below 100,000 from 110,000 in January 2023. The firm, which transports goods for major retailers such as Nike, said profits had plunged by 92% in its most recent quarterly results. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Tim Huxley, Chairman of Mandarin Shipping. And providing a view from Mainland China will be Yanan Wu, the Chairman and CEO of Surfin Group. If you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, after 3 straight months of losses, the S&P 500 notched its best week of the year. The S&P 500 stock index closed up 0.9% on the day at 4,358 and 5.9% over the week for its best 5-day gain since early November 2022. The Dow rose 222 points, or 0.7% to 34,061. Over the week, the Dow added 5.1%, its best 5 sessions in more than a year, and the last time it advanced more in a week was back in October 2022. The Nasdaq Composite jumped 1.4% to 13,478. For the week, the Nasdaq was up 6.6% in its best week since November 2022. Treasuries climbed across the curve. The yield on the 2-year US Treasury note, which moves inversely to price and tracks interest rate expectations, dropped 14 basis points to a 2-month low of 4.85% following the jobs data, as investors cut expectations of further monetary tightening. Yields on 10-year notes dipped below 4.5% for the first time in a month. Oil futures were sold into the weekend on the soft US jobs data, and after Hezbollah's leader said the group doesn't plan on conducting a large-scale attack on Israel for now. Brent crude rose as high as $87.80 a barrel in early trading, but then reversed to fall 2% to $84.89 a barrel. For the week, Brent was down 4.8%. Gold put in a poor performance over the week considering the slump in the US dollar. Spot gold rose 0.33% Friday to $1,992 an ounce for a weekly loss of 0.7%. The US dollar saw massive selling, with the US dollar index down 1% against a basket of peers, its biggest weekly drop since July. The US dollar Japanese yen rate ended the day 0.7% lower at 149.37 yen per dollar. Onshore and offshore yuan were buoyed by improved dialogue between China and the US. In Shanghai, the yuan was up 0.2% at 7.30 renminbi per dollar. China's Shanghai Composite Index rose 0.7% to 3,031, snapping a 3-day losing streak. For the week, it was up 0.4%, underperforming most US, European and Asian benchmarks. Hong Kong's Hang Seng Index was up 434 points, or 2.5% Friday, shrugging off a survey which showed the city's private sector activity contracted further in October. The Hang Seng saw a weekly gain of 1.5% to its highest level in over 2 weeks, and its second straight week of gains. Looks like that may continue at the open this morning. Futures markets pointing to a gain of about 100 points for the Hang Seng, that's 0.6%. The index projected to start the day and the new week at around 17,765, and you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Part of a brand new week. Let's welcome our Monday morning guests. We have with us Alex Wong, Director at Alex KY Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also joining us, Tim Huxley, Chairman of Mandarin Shipping. Morning to you, Tim.
Good morning, Peter.
Non-farm payrolls increased 150,000 last month. That was less than expected, and also barely half of a downward revised 297,000 advance in September, a Bureau of Labour Statistics report showed Friday. Economists had expected a total of 180,000 new posts for October. The August figure for new jobs was also revised downwards by 62,000. The unemployment rate, that climbed to a 21-month high of 3.9% in October from 3.8% in September. The survey of households showed a more than 200,000 increase in those who'd lost their job or completed a temporary one. And the report also showed monthly wage growth slowing and the participation rate ticking down. Average earnings edged 0.2% higher. That's a slight slowdown from the 0.3% increase in the previous month. Earnings were up 4.1%. from a year earlier. That's the smallest annual advance since mid-2021, following an upwardly revised 4.3% in September. And in a departure from the recent trend, the supply of labour declined, prompting a drop in the participation rates, the share of the population that's working or looking for work. That's the labour participation rate. It's at 62.7%. Alex, are we seeing now the first signs of maybe the employment market starting to crack in the US and slow down?
Yeah, I think so. I think we probably will have, we are seeing the impact of the high interest rate finally. So I think this is impacting the employment market. So very likely, I think this may continue as a trend.
Yeah, I think that's certainly the case. People are just not spending the money, and you've seen that with that mention you made about Maersk, their issues at the moment, and. Yes, I'm not particularly upbeat about expectations for the next few months.
We're starting to see, aren't we, layoffs increase in certain sectors like the financial sector, like technology, and now we have that Maersk news as well. There are signs, aren't there, Alex, that these layoffs are starting to pick up?
Yeah, I think for finance sectors, because actually the market actually have been going nowhere, especially in certain parts of the world. So I think that probably is the part that we will probably continuously lay off. And for the tech, I think many companies actually are downsizing because probably of the advance of AI. Of course, we probably may see some pickup in AI jobs as well. And I think probably we may see the real economy to start to suffer, because right now probably we may see people to spend less, and also I think that they've switched to experience spending more, so that would, I think, affect a certain kind of jobs.
Is this what data that we're seeing? Is it consistent with a soft landing that the Fed hopes to achieve, and the economists are saying that they are going to achieve? Is the data in line with that, or has the Fed overdone it, and is it at risk now of tightening us into a recession?
I think they probably eventually would have overdone it. I think they probably may still let the high rate to stay for quite some time. Right now, people are expecting the rates to peak, but I don't think they would go down. So I think we probably may still see the Fed overdone the situation.
In your industry, Tim, are you seeing signs at all of a recession?
Oh, well, certainly. I mean, as you see, that data from Maersk, I mean, since cutting their January 2023 headcount by 10,000, their third quarter profits came in at 538 million. Now, this is one of the largest container shipping companies in the world. So their third quarter profits in at 538 million. previous September third quarter in 2022, it was 9.5 billion.
What a turnaround!
That is a pretty spectacular decline.
Yep.
Now then, shipping always has its own particular issues, but this very much does reflect what is going on in the wider world. And we are going to need an upturn in trade, which doesn't seem likely at the moment. So what you're going to have is ships being pulled from services, trying to reduce capacity. Maybe some of the older ships will get recycled. But then we've got actually quite a long-term problem here, because over the next 18 months, you've got more new container ships being delivered from shipyards than you've had in the whole of the previous 5 years. And this is a massive hangover from when, during COVID, these companies were making so much money. And a lot of it was being invested in new ships, environmentally friendly ships which can run on LNG, ammonia, various other different alternative fuels. So there's been massive investment in the industry, but it all means extra capacity. Now, fine, 90% of everything goes by sea, so this is a critically important industry. But you've now got this massive overcapacity, and that will take years to work your way through.
Is this boom and bust normal for the shipping industry? Does it normally go through these cycles, or is this one a bit extreme because of COVID, when, as you say, they were just making massive amounts of money, weren't they? They were shipping a lot of goods, so that there was high demand, and now that's all gone into reverse. Is this more extreme than normal?
This, in the container sector, this has been particularly extreme, but boom and bust is the nature of the shipping business. This is not a business for widows and orphans by any stretch. And but are we going to have issues with shipping companies going bust or whatever? Well, there was so much money made over the previous few years. They have all managed to pay down a lot of debt, and so there was quite a lot of money in the system. But you can burn through that pretty quickly. So we're not looking at a really great outlook for into 2024. I mean, and the CEO of Maersk, he said things better improve, or 2024 will be dire.
Right.
So,
with companies going under.
Well, could be, but if shipping has this amazing ability to sort of readjust, and so what we'll see capacity withdrawn. People will stop ordering new ships. Values are much lower, and the cost of a ship, because I mean the second-hand market for ships is a market in itself. It's like real estate, and those values are coming down. So. But this is the magnitude of this overcapacity problem we've got in the container sector at the moment is going to take quite a long time to work through. So I'd hold on into next year before you start putting your money into it. And I just look at it. I mean, I was actually in Europe a few weeks ago at a conference. I was chairing a panel there, and I had 4 ship owners who between them own over 200 bulk carriers. And I asked the final question I asked them was, if I give you $100 million, what are you going to do with it? Where would you invest it? And it wasn't, I'd invest it in economical bulk carriers or something. Each and every one of them said 3 months treasuries. So they're not looking to invest.
Not in their own business,
No.
then. But even though this is dire, obviously, for the container shipping industry, if you're the person paying to move goods from A to B, it's probably pretty good, isn't it? Because it should allow you to be able to negotiate a lower price.
Yeah. I mean, spot rates on containers. So if you, say, wanted to move your furniture from Asia to the UK or something, the cost per container, yes, that's dropped massively from the highs we were suffering in COVID. Now, so yes, the cost of moving one of these metal boxes has dropped, but the problem is that people are not buying what you carry in those boxes. So there's actually, so it's all round. It's this circle we've got, which is driving everything lower, and shipping is just part of it.
And you say there's been sort of overcapacity now. They've presumably didn't see this coming. They carried on ordering new ships, and these ships are being built, but there didn't seem to be any sort of forewarning or any sort of foresight about interest rates were going to go up, and the economy was going to slow.
Ship owners are their own worst enemies some of the times, and they'll always sort of say, well, wait a minute, look, the earnings are really good, I'm going to order a new ship, and so, but I hope nobody else does. But of course, everybody does. So
Right.
you get this sort of herd mentality, and everybody goes in, and the shipyards are out there selling these new designs, and everybody's been making money. So it's just, and interest rates were very low. So it really was very attractive to do it. But sure as the sun will rise tomorrow, you get a surge in new orders of ships, and you will then have a recession. When it combines with a really difficult global economic outlook, then this can be, this is on a scale of, say, the shipping recession we had in 2009, where on certain sectors, I mean, there at that time, the cost of moving a cargo of iron ore from Brazil to China, you'd be paying about $300,000 a day in May of 2008, I think it was. By October, you were down to $3,000 a day. So it swung by 99%. And that's the volatility in the nature. And one of the attractions of shipping.
You have to be a bit mad, don't you, to want to be in this industry?
I think brave and able to take a sort of reasonably cautious long-term view.
Alex, is what Tim's describing here for the shipping industry, which is obviously pretty extreme, is this a warning for the global economy? Because companies like Maersk, they're sort of bellwethers for global trade, aren't they?
Yeah, of course. I think people probably should guard against the long-awaited recessions to come, I think. But now the market actually take that as the best case scenario. I think they think if a recession comes, then the US interest rate will come down. So that may be good for stocks. So I think people regard that as the best case scenario. But I think we have to also look at the earnings side, not just on the interest rate side.
I mean, the markets were pretty euphoric after this jobs report. I mean, basically they're saying that the global cycle of interest rate rises is over, not just in the US, but also in Europe as well. And the central bank has sort of pretty much confirmed that. Are they right? Are we now at the turning point for interest rates?
Yeah, I think probably we may not see the rates to go up, but the point is they will stay high. I think. So this interest rate environment, I think, would stay for quite some time because I think, as I've said, the Fed would overdone it. So eventually, I think people would recognize that. So we probably may still see the impact of high interest rate. The rate right now is still high enough, I think, to deter the economic activities.
And when you look at the data, I mean, the way the markets are sort of reacting to that is that we've sort of reached a peak, but at the same time, are they pricing in enough the fact that these rates are not going to come down?
No, I think we are actually seeing some kind of short covering last Friday. So we are seeing smaller companies to pick up at a very fast pace. I think that's the characteristics of a short covering. But if you look at ARKK, actually this is up 15 to 20% in just a few days. So I think that is the power of a short covering. But I don't think people are discounting the risk of earnings because they probably may still be covering their shorts on this rally.
So what moves markets next then? Because if now, it's been really, markets have been moving, and particularly the Treasury bond market, on whether or not we're at the end of this rate hiking cycle. If markets have now assumed, yes, we are there, that's the end, they're going to stay higher for longer. What do we focus on next now? Is it the economic data and whether or not we're slipping into recession? What is it?
I think we'll still be earnings driving the market. So we probably may see polarized performance. So I think we will see a very narrow-based market strength. So very likely we may see second-tier companies to come down because of the risk of earnings. But the big ones, I think people think they will survive, and actually with the help of AI boom, I think they probably may still like companies like those biggest tech. So very likely, I think the market would be tilted towards the biggest one. So if you look at the index, probably you will still feel the market to be okay. But if you look at the Russell 2000, I think you will feel that in a bear market later on.
So if the Fed is now done, we've had all this buying in bonds and stocks. They're sort of both going up and down together, aren't they, at the moment, bonds and stocks, where we had a whole period where they were going down together. Now suddenly they seem to be going up again. This rally, though, is it going to run out of steam fairly quickly?
I think if you look at the Nasdaq, probably it's difficult to call. But if you look at the Russell 2000, I think it should run out of steam quite soon because the short covering would not last a very long time. I think the most fierce part probably has been done. So we may see some small extension, but I don't think the upside would be too much in the short term, even in the short term. Yeah.
The irony is the Fed is sort of been relying on the bond market to do some of the tightening for it, and it's been basically saying it doesn't need to tighten any further because the bond markets are tightening through the financial markets. But that's sort of at risk of getting unwound now, isn't it? If bonds suddenly start soaring like they've done and yields come down, then that sort of tightening goes into reverse.
Yeah, of course. But I think if you look at the bond market, I don't think people would be very optimistic towards their long end because they had felt the pain during the decline, and then you are stuck with the bond for quite some time. I think they probably would be very cautious in investing to those long end because even. They probably even would question about the repayment ability of the U.S. government because the public finance actually is quite very messy over there. So I think people probably would put a new premium on those long end. So I think the bond market may not have too much rebound on the long end side.
Okay. I mean, Tim, this is a significant moment, isn't it? Because if interest rates now have finally peaked after, 2 years of basically central banks underestimating inflation and having to tighten much faster than they thought to try and get this down, but nevertheless they have done it. I mean, the US inflation reached a peak of almost 10%. We're now down to around sort of 3%. It feels like this is a significant moment for both, not just the markets, but also for the economy as well.
Yeah, but I agree. I mean, we're going to be with higher interest rates for some time to come, and we got so anaesthetised to low interest rates and all of the problems. And they did cause a lot of problems. So we're going to have to live with these higher interest rates. And that will probably actually, if there are other factors at play, that's going to hold back on companies investing. And so we're not going to have that growth that would come there. So I'm extremely cautious at the moment. And, I share the view of my fellow ship owners of saying, well, just hold off a bit at the moment.
If you look at it through the shipbuilding eyes or the ship container eyes, it's not so great. But
if you're a ship builder, you're absolutely running flat out through until 2026. Probably in the passionate hope that your customers are still going to be around then to pick up the ship that they ordered. But it's certainly for the end of this year. I'm not looking for any fireworks.
I mean, it's an important point because companies are going to have to refinance at some point, aren't they? Maybe they've locked in, these low rates for a while, but eventually, and not all the companies have, but eventually you're going to have to refinance. And that's when really you're going to find out who's been swimming without any bathing costume on, as Warren Buffett famously says.
Indeed, the tide will go out. And that's really going to be the day of reckoning for quite a few businesses.
We're starting to see, Alex, credit now contracting once again. That last happened during the financial crisis. How much of a warning is that for us?
Of course, I think because people are very cautious towards the long end, and they probably may just do short-term treasuries. So I think that's why we are seeing credit to lock up. And for companies, actually, they need to refinance at the higher rates, and it is difficult to issue bonds. I think for those smaller companies. So that's why I think we are seeing credits to tighten, and that I think may be a potential. Very bearish factor.
And are credit spreads widening in the market? That's also another warning sign, isn't it, usually?
Yeah, of course, yeah.
Now, what about China? A private gauge of China's services activity grew less than expected in October. The Caixin China General Service PMI, it rose slightly to 50.4 in October from September's 9-month low of 50.2. That was below the consensus estimate. Many economists of 51. I mean, Alex, when we look at all the data we had out of China last week, we had the whole series of official data and the Caixin data. Looks like a fairly consistent picture now. Manufacturing back in contraction, services just about holding up, but not great.
Yeah, I think, of course, right now China is still facing the problems of its housing market and also the relocation of many manufacturing activities and also probably the global recession risk. So I think that those bearish factors actually also remains on the economic side. But people actually are picking up some stocks because we have so many policies supporting and also the global interest rate peaking scenario also helping.
Tim, renewed deterioration, isn't there, in factory activity on the mainland?
Well, yes, but also on the service sector. I mean, that was, the great hope that was going to expand, and that's obviously not expanding as fast as what people had hoped. So that, and then the cutback in manufacturing. There is a lot of talk about some relocation, but as we've talked on this program before, I mean, relocating a factory out of China and setting up somewhere else, it's a big ask. I mean, training of staff and all of that. So, I mean, China is still going to remain a critically important manufacturing base.
I mean, the average of the two services PMIs, the Caixin and the official one, it's now at a 10-month low of 50.3. And if you're looking within the sub-indices, it seems to be the property sector, investments there and construction that's really sort of dragging it all lower.
Yes, and then that has a knock-on effect on industries like steel and cement, and so that's actually a really quite a significant number there.
Seems to be weak across the board, really, doesn't it? Is this because of the property sector? Is that really now having an impact spreading out to, other sectors? Because when you look at the whole series of PMIs, they really were, well, as I say, weak across the board.
Well, property is such an important factor in the whole Chinese economic story. So if there's bad news there, then it will ripple through the whole economy.
What's China got to do to try and avoid, the economy slipping further?
Oh, Peter, that's a heck of a question. I mean, what has China got to do?
Many things.
There are a multitude of things at every level in society, and I think there are still a lot of good stories there. And you look at the growth of where they've achieved a dominant position in things like manufacturing of electric vehicles and some of the sort of technology areas that they're they've really got the ball and they're running with it. And then if you look at the growth of renewable energy in China, I mean, again, a huge amount of capacity is coming on stream, so they're making enormous progress there. But it's such a huge economy, such a vast country, there is no easy solution to any individual problem.
It seems to be that what China is saying at the moment is, or one of their solutions is, they are going to basically borrow to invest in manufacturing, to try and boost the manufacturing sector. They're also talking about trying to relieve some of the pressure on the local governments. The problem is, though, how do we know that all this investment is going to go into productive investment? It didn't in the property sector, did it? They, initially they wanted to invest in the property sector, and it's turned out to be rather unproductive investment. The risk is they're just going to do the same thing in the manufacturing sector as well.
Well, yes. I mean, when it comes to manufacturing, I mean, the one thing you're just going to be sure of is that you're going to manufacture stuff that people want to buy. So get that product.
And that's the problem. There isn't the demand at the moment.
Yes.
It's not as if there isn't enough manufacturing or enough investment or enough credit. It's just that there's not enough demand.
Yeah. And I think that's, at the moment, until people are more comfortable, until people are more confident, that's the situation I think that will actually continue.
And what about Hong Kong? Hong Kong's private sector activity, that contracted further in October as new business, including that from the mainland China, continued to fall. The S&P Global PMI dropped to 48.9 in October from 49.6 a month earlier. That's the fourth straight monthly fall in private sector activity. Alex, also this has been combined with the news from Paul Chan that our economic growth is going to be revised down. It's going to provide a new forecast this week. What's your assessment?
I think Hong Kong actually is very gloomy right now, because if you look at every pillars of the economy, we are facing challenges. So I think it probably makes the economy to still go down, I think. Because if you look at the private consumption sectors, I think many Hong Kong people actually are spending on online shoppings from China. And then even for the experience spending, they are going to Shenzhen now. So very likely we might continue to see the retail market to shrink. And then for the housing market, I think probably, hopefully, we will stabilize, but I don't think we would have too much activities. And for the equities market, unless we got some big companies coming in Hong Kong, I think we probably may still have a low turnover for a while.
If you look at the GDP figures, they grew 4.1% year on year in the third quarter. That sounds quite good, although you have to bear in mind it's the base effect is there. We're comparing it with a poor period. But if you look at the sequential growth, how it grew quarter on quarter, just 0.1%. I mean, that's pretty meagre, Tim, isn't it?
Well, that could be almost be an accounting error, couldn't it? It's you look around in the Hong Kong economy, it is pretty slow. People are being cautious. People aren't out there spending money. I mean, fine, the streets are pretty busy over Halloween, but outside of that, you go out and restaurants and everywhere, it is still really struggling. So we've got a long way to go. Hopefully, we'll have more people visiting, and maybe businesses will continue to see the benefit of being based in Hong Kong, but we have got quite a battle ahead of us.
We're also having issues on our financing, aren't we? The budget deficit now. We've got the new race to see who can come up with the next estimate of what our budget deficit is going to be. But Deloitte's is estimating about 130 billion Hong Kong dollars. Paul Chan was saying 50 billion at the beginning of the year in his budget. Is this becoming a problem as well, or are we in a good position in that at least we can borrow?
I think first of all we can borrow, but if you want to solve that deficit, I think you need to see a revival in land sales. The only way to solve that problem is land sales. But with high interest rate, it's very difficult because if you look at the discount rate, actually we are up for probably 5% already, and then you are and the development process of a land in Hong Kong actually extremely slow. So we probably may need to discount that rate for 7 to 8 years. Then that means we have a very huge depreciation in land value, and the government is not willing to accept that. So I think that's why we are seeing no land sales at all right now. So I think if we cannot solve that problem, if the government do not want to sell the land at the new reasonable level, then I think we probably continue to see the deficit to balloon. Yeah.
I think the figure is the revenue from land sales is only about 18% of what was forecast at this stage of the year. So a massive shortfall.
Yeah, I think another thing is that they need to speed up the development process in Hong Kong. I think that the red tapes are too serious in Hong Kong right now in development of land sales, the development of a property. So I think that they need to speed up that so that we can discount less, 2 years less, and that is helping at least 10% of the value.
Tim, this is there's going to be a lot of focus on this, isn't there? I think in the coming weeks on our revenues, on our budget deficit, on the decline in our reserves. So I think some people are going to start to get quite worried about it.
But we've always had that. I mean, we always, undershot or overshot on estimates. It would seem
not very good at forecasting, really, are we?
No. So let's sort of see how that evolves. But the fundamentals are there. It will be a difficult period ahead, but how many difficult periods have we come through? I mean, I tell you what, I'm feeling a lot happier going into next year of not having sort of quarantine and all the COVID restrictions and everything. And we'll come through it. And there's always a silver lining somewhere. I remember, we were talking about the container shipping industry. COVID was their all-time boom. So, there's a silver lining to everything.
Okay. Alex, final thoughts from you on the markets. Hong Kong stocks jumped by the most in 2 months on Friday. Finally, we've seen a weekly gain of about 1.5%. So we're at the highest level in over about 2 weeks. But is it going to last?
This is a very difficult question because we have so many times of failed upside attempt in the last few months. I think if you look at the property-related counters in Hong Kong, I think they probably may not have much upside left. And the big techs, I think, are mainly on short covering strength because the sale of big shareholders still remain. So I don't think that they probably may have too much upside. If you go for the big ones, I think Hong Kong EX probably may be the only one worth to try because probably may finally get some companies to come to Hong Kong to list. So I think if you look at the overall picture, this is not too sexy right now. But the good thing is that we are seeing some strength in certain counters like Lenovo, Xiaomi, and the EV sector. So some people are picking up values in Hong Kong right now. So we are seeing some improvement in certain sectors. But overall, I think we may not have too much upside in the broad-based market.
Okay, well, thank you both very much for your thoughts this morning. You heard there Alex Wong, who's director at Alex K.Y. Wong Asset Management, Tim Huxley, who is the chairman of Mandarin Shipping.
Peter Lewis's Money Talk.
I'm joined now by Dr. Yanan Wu, who is chairman and CEO of Surfin Group, which is headquartered in Singapore. Morning, Yanan.
Morning, Peter. How are you this morning?
I'm very well, thank you. We had a lot of data last week, didn't we, from China? We've had the whole series of PMIs, both the official PMIs and the Caixin PMIs. The sort of feeling seems to be manufacturing has slipped back into contraction, services just about holding up, but not looking great, really, was it?
Yes, indeed. Both the national PMI and the Caixin PMI both at 49.5 in October, and the Caixin PMI, has decreased about 1.1%, 1.1% compared to September. So it's still back to the contraction side, the manufacturing, as you just mentioned. I think the main reason was two parts. One is the demand is still lack of support, and secondly, the price actually dropped. So if you look at the October production index, which was 50.9% in October, is actually 5 months expansion. The new order index actually is 49.5%, and purchasing index at 49.8%. Both dropped back to the contraction, region. So that indicates whether new order or the purchasing, they both show the demand as really weak. And in addition, the raw material, purchasing index and also the factory index have both dropped compared to September, 6.9 and 5.8%. So that's really shown the demand is not there, and also the global commodity price also dropped in October. If you look at the oil price, despite the Middle East this geopolitical conflict, both London, Brent oil price and the New York OPEC price has both dropped about 3% compared to the average monthly price, and it's even dropped to 12% compared to September. So all these factors, whether it's demand side or the international commodity price, both contribute the manufacturing PMI back to the contraction period.
And the government's solution to this, one of its proposals, seems to be basically to borrow more money, increase the budget deficits, borrow maybe $1 trillion yuan, and then use some of that to invest into new manufacturing. But I'm wondering, isn't there the risk here that they're just going to invest more into unproductive parts of the economy, just like they did with property? It didn't really go into a particularly productive part of the economy. The risk is going to be the same with manufacturing, because the problem is it's not that there isn't enough supply and there isn't enough credit. The problem is demand. Yeah, demand.
That's probably the keyword current, in the macroeconomics. And the policy seems also to evolve around how to revive demand and also how to restore the confidence. The main, the part for the demand is property sector. That's the most leveraged, industrial sector. But if you look at the bank credit, in those two sectors, whether it's the industrial sector and also the property sector, property sector continue to drop, in the bank credit, and because of all various policy in the past few years. The industrial sector, the credit increase, trying to hedge against the drop of the property sector in the bank loan books. So that's indicates the bank want to support the whether it's construction or manufacturing to really offset the property sector sloppiness. So if you look at the October service PMI, it's actually even despite the October Golden Week, the number actually still showing weak. It's the service PMI is 50.1%, and again dropped 0.8% from September. So that's mainly caused by the property sector and also the capital market, the overall service sector. So that shows that both, the consumer side, the October Golden Week picked up a little bit, but still the consumer confidence is not there yet, and also the construction sector, still remain to be, shown in the next few months, and of course the stock markets, capital market also showed lack of confidence. So all these, contribute to the service sector. Or the demand side is still kind of weak and sloppy. Yeah.
As you say, this is really a confidence issue. I mean, people have lost confidence in their housing markets. I presume there's also worries about employment as well, particularly when you look at those Caixin PMIs, because so many of those companies are crucial to job creation on the mainland. It's these private enterprises that create about 80% of the jobs. Is there a worry now that the weakness will just stop firms hiring, and that will also drag on consumer confidence, I presume?
Yeah, that's it could be correlated to a quite certain level, and also it may cause a vicious spiral, downturn, from demand to lack of investment and reinvestment, and also lead to unemployment rate hikes. Again, that leads also to the even weaker demand. So that's kind of a spiral cycle. So that's why I think in this recent, just concluded the Central Financial Committee meeting, there's quite a few policy related to how to increase the financial investment on the national level to be a more strategic policy. I think the most focus is on three areas, so-called that's related to the productive housing, to make sure the average, the lower income can have housing to live, and also the second is the so-called the village among the city to try to renovate. So that's the second part since 2014 regarding the sham house building reconstruction, and thirdly is around the public infrastructure investment. So all those three areas trying to offset the sloppiness in the property sector, and if you look at the government local vehicle, that level is very high. That's why I think we have seen the 1 trillion RMB government bond special issued for. Just announced by the PBU, by the Minister of Finance. Actually, 500 billion have to spend by the end of this year in the fourth quarter. So that's trying to offset the debt level in the local government vehicles. So in certain province, the average government level debt has reached 75%. In certain areas, even government local debt level has reached over 100%. Especially the local government vehicle has reached a maturity hike as of this year. So 2023 alone, the overall the maturity level of government local vehicle has reached 5 trillion, and that's the highest peak since the last decade.
So what?
Yeah.
What does the government propose to do about that? Is it saying that it's going to take that debt off of local governments and put it on like the central government's balance sheet, or does it still expect the local governments to bear the losses? Because the losses are huge, aren't they? Someone's got to bear these losses somewhere. Where does Beijing think those losses should be?
Yeah, I think the central government's bond, the 1 trillion one, is trying to use as a leverage to increase more, the debt payment for local government. Just 1 trillion national government debt is not sufficient to pay all of the local government, debt. So there's some special projects trying to to have the local government to apply to the central government in order to use or access to this one special 1 trillion bond. So, and this local government still have to put in additional, spending for accessing this national debt, government debt. So that's a kind of leverage vehicle, if you will. And that 1 trillion RMB already, contribute to the deficit GDP ratio from 3.3%, at 3.8 trillion deficit to 3.8%, about 4.8 trillion RMB. So that's already overpassed the ceiling of the normally set by the central government for the deficit level. So the local government still facing quite significant pressure despite this 1 trillion RMB support, because the land selling revenue continues to drop for local government, because that's mainly the government revenue income, where it come from. Especially when you look at the first half of 2023, the national on the whole national level, the land selling revenue has dropped 23%, compared to last year. So that means the revenue continue to drop local government, but the maturity of the local government vehicle debt still reach a hike. So it's still quite a bit to challenge ahead of how to resolve the local government debt, burden.
And of course, this is all hanging over the markets as well. If we look at the performance in both Hong Kong and Shanghai, the Shanghai composite is year to date, it's down 2%. The Hang Seng is even worse. It's down almost 11%. It's the worst performer among the major global equity index gauges. And foreigners have been selling mainland stocks in record amounts over the last 3 months or so. What's it going to take to get confidence back in the markets and to get a rebound going here?
Yeah, indeed. Both Asia and Hong Kong Hang Seng Index are the two worst performers, so far among the global major capital markets. And if you take a 3-year level, for the last 3 years, the most performing, capital market globally actually from India, that's what you normally covered in your Indian podcast, and also Indonesia and Vietnam. So those 3 emerging markets actually pick up the momentum for the last 3 years, showing the capital market confidence and also the supply chain dividend for those regions. Even NASDAQ for the last 3 years is compared to these 3 emerging markets actually show a less underperformance. In contrast, Shanghai stock composite has still, battling around the 3,000 point level. That's it was some joke about, this is the 50th time that since for the last 20 years, the Shanghai composite has still battled around 3,000 point level. On one hand, we recognize that indeed the capital market has a much higher market capitalization compared to a decade or 2 decades ago. But this year alone, the IPO level in Shanghai and Shenzhen actually is the highest among the globe. So even surpassed the US IPO level. So that means supply is still driving, is contributing a lot to the stock market, and that itself has caused the underperformance because there's just not enough liquidity in the capital market with such a high level IPO. Secondly, so-called northbound hot money, they basically the foreign investor, lose the confidence or has, show uncertainty for the Chinese capital market. So they basically left, gradually leaving the Chinese capital market. And that alone has caused the downward pressure and even caused more negative confidence to the domestic investors. So those two factors, I would say, IPO level and also the import of the downward price has caused even more confidence drop for both sides. So it's all about confidence, how to restore the confidence back, and the reverse expectation for the capital market is the main work had to do. That's why the capital market calls for the national, the Huijin capital, whether it's the government intervention or the Huijin money has to inject it into capital market to show a so-called national team has to support this capital market.
Okay, well, Yanan, it's always a pleasure talking to you. Thank you very much indeed for coming onto the programme this morning.
Thank you, Peter.
That's Dr. Yanan Wu, who is the chairman and CEO of Surfin Group, headquartered in Singapore.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian Fund Management Industry Consultant Stuart Aldcroft, James Wong, Chief Executive Officer at Cathasia Securities, and our US economics correspondent, writer and broadcaster Barry Wood. Bye for now.
Money Talk.